Hey Bowtie Nation, Joseph Hogue here, and a major update to our 2022 stock portfolio with 3 stocks I'm buying now that could not only protect your money, but put you first in line for returns in the next bull market. The market just saw the biggest news of the year for banks, but because stocks are in such a funk, nobody seemed to notice. In fact, since that time, stocks in the KBW Bank Index here in green have outperformed both the S&P 500 and the Nasdaq Index. In this video, I'll explain what those stress test results mean for the bank stocks and how financials can protect your money in the crash. I'll show you why bank stocks are the first to rebound in a bull market, and then reveal the 3 stocks to buy right now. I'll leave a link to stock card in the video description below. Click through and then go to portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the list. If you do sign up, don't forget to use the promo code Bowtie Nation, that's all one word in lowercase, for an exclusive discount beyond the free trial. Now, I've been watching the bank stocks all year on those rising rates, and while they've fallen along with the rest of the markets this year, news hit recently that could turn the industry around. The Federal Reserve just recently released the results of its stress test, a measure of the financial strength at each bank if the economy really tumbles. Even under the worst conditions, though, banks will have enough to satisfy those capital requirements. Now, that's important because not only does it ease investors' fears that the stock crash could turn into a financial disaster like 2008, but it also frees those banks up to increase their share buyback and dividend payouts. In all, the major U.S. banks alone could return more than $80 billion to shareholders this year. In analysis by Barclays, JP Morgan has the most capacity to pay out, with the potential to return almost $19 billion to shareholders just this year. Estimated dividend payouts are in orange here, with the stock repurchase programs in gray. JPM here is followed closely by Bank of America and Wells Fargo, each with liquidity to return more than $15 billion to investors over the next year. Now, I want to get into that list of stocks I'm buying, but stick around because I'm going to show you why I think bank stocks could protect your money and offer the best source of returns when the new bull market starts. Now, we already have a few bank stocks in the portfolio. Our shares of Citigroup were up 81% in the 7 months to last May, but have since crashed along with the market. Now, we're still up 9% on that, and it's still the single best value in bank stocks, trading at just 0.5 times on a price to book value and paying a 4.4% dividend. We booked a 70% return on shares of Wells Fargo, ticker WFC, last year, and I'm adding it back to the portfolio after the shares have come back down. Wells Fargo increased its dividend 20% after the stress test results, boosting the quarterly payout to 30 cents a share and the yield to 3% a year. Now, it is still under an asset cap imposed by the Fed after the scandal, and that's going to limit how big the bank can grow, and it's not likely to come off this year, but probably next year, and could be a big catalyst for the shares. Despite the problems, though, Wells Fargo is still the 3rd largest bank by deposits after JP Morgan and Bank of America. Now, that's going to help drive interest income as those interest rates increase. Shares are down 35% from the peak last year and trade for just 0.95 times on a price to book value. Besides, during the pandemic crash, that's a 10-year low and a discount of 20% from the 5-year price to book average. The average analyst target here of $56 a share is 45% higher from here, and while I doubt we get there this year, it's a solid long-term return. Now, the lone dog of the group, shares of Citizen Financial Group, ticker CFG, are down 14% from adding them to the portfolio last year. And while I do like the regional banks here, Citizens is really only a regional bank in name only, with more than 1,000 branches, $183 billion in assets, and customers in every state. It's evenly split between consumer lending and commercial banking, both of which are really holding up. I still like Citizens on that smaller community bank feel. Even though earnings are down this year, revenue and income is expected back up 20% next year, and shares pay a solid 4.3% dividend while we wait for that rebound. The stock is down 37% from the peak, but the average analyst target of $50 each represents 41% upside from here. I'm going to show you the 2 totally new stocks that I'm buying next, but I don't want you to think these stocks are just going to rebound immediately. If the stock market does keep crashing, and I think it will, all of these stocks, even the best bank stocks, are going to fall with it. But there is a very good reason I want to be buying these stocks right now, ahead of the next bull market. First, because the banks are in a lot better shape than investors even realize. The market is still a little shell-shocked from that massive beating the banks took in 2008, and the bank ETF, that KBE here, is down 27% from this year's highs on fears of another financial crisis. But first quarter results from JP Morgan show that deposit growth is still strong, up 15% for consumers and small business accounts. Credit card spending was also up through the quarter, and credit lending was strong as well. And now, with that deposit growth, banks may be the only companies making money off higher interest rates. That net interest margin, that's the difference between the rate banks pay on deposits and what they collect on their loans, it just fell off a cliff as interest rates fell to nothing during the pandemic. As the Fed raises rates, though, that's starting to change. Anyone with a savings account knows banks are still paying next to nothing on deposits, but they're collecting more on their new loans. Now, bank earnings were down in the first quarter, but it was really a little bit of financial hocus pocus rather than poor performance. Banks have again started to move money into what's called a loan loss provisions account, a cash safety net that is set aside just in case loan defaults get bad in a recession. In all, U.S. banks moved more than $5.2 billion from earnings into these accounts in the first quarter alone. But we've already seen how businesses and consumers are still flush with cash. Now, that will change in a recession, but it's likely to be a much lighter recession than in the past, and banks are still going to be able to boost those earnings by moving those loan loss provisions back onto the income statement. So here we have the bank stocks, already down 30% from their peak, trading at the cheapest price to book values in more than a decade, and in great financial shape. But there's one more reason you want to be buying these stocks now rather than wait for that next bull market. And it's because interest rate sensitive sectors like the financials are the first to boom higher in a bull market. The graph here is a little busy, but this shows how each sector performed in the early stages of previous economic cycles. Now, the green and blue bars are returns on stocks in that sector, and you can see the return on financials is second only to real estate when the economy takes off. So the thing here is, by the time the next bull market has started, by the time investors are confident that it's a recovery and not just another bear market trap, the biggest gains in bank stocks could already be over. I'm also adding shares of Bank of America, ticker BAC, to the portfolio for its interest rate sensitivity on those higher rates. Bank of America books more than $1.9 trillion in deposits, second only to JP Morgan at $2.25 trillion, and that means it's going to be one of the most sensitive to that rate spread difference. As interest rates on those loans head higher, it's going to make this stock a cash flow machine, and the bank increased its dividend to 22 cents a share after the stress test. Now, that boosts the yield to 2.8%, and the bank repurchased $25 billion of its shares in the last year alone. The shares aren't quite as cheap here as the others on the list, at 1.07 times on the price to book value, but that's still a 9% discount on the 5-year average, and that $47 average price target represents a 51% upside for investors. Now, you can't talk about bank stocks without JP Morgan, ticker JPM, and I'm adding it to the portfolio for a great 3.5% dividend yield and exposure to the capital markets. And JP Morgan is the leader in banking with over $4 trillion in assets and about half of that in deposit accounts. It also has the strongest capital markets business in the industry, which is why it's outperformed over the last 5 years with a return of 28% versus that broader banking ETF. Now, the bank did maintain its dividend at $1 a share after the stress test, but increased it 11% last year and has doubled the payout over the last 5 years. Shares are down 35% from the peak and trading at 1.35 times on a price to book valuation, the highest on our list, but not expensive if you consider it's traded at an average of 1.6 times book value over the last 5 years. Analysts have an average target of $154 a share, nearly 37% higher from here on top of that dividend. Check out the 2022 portfolio on Stock Card or click on the video to the right for the 5 monthly dividend stocks that beat the QYLD, 5 stocks that put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.